Okay, welcome back. We are on page 6 of chapter 9. So, we just finished a calculation of consolidated net income. This should have had a little title called Calculation of Beginning Retained Earnings. Now, we already determined earlier that we needed to do beginning balance as we're doing a statement of retained earnings. Now, the good news is, in the first year, the beginning balance of consolidated retained earnings is only the balance in the parent's retained earnings. Okay? Because what goes into retained earnings is the earnings, right? And that hasn't started at the beginning of the year. And the dividends, we'll just assume haven't been paid. Always just go dividends at the year end unless they tell you otherwise. So, the first year, only the first year, beginning balance is the balance in the parent's retained earnings at acquisition date. And we're going to complete a consolidated statement of retained earnings, so we need to calculate ending consolidated retained earnings. And this is step 6. Okay, now we're going to calculate NCI at the end of year 1 for the consolidated balance sheet, which is step 7. Okay, there's 2 ways you can do that, and it doesn't matter which one you do. This method always works for your problems, and they aren't called anything different, it's just 2 different methods. So let's call it method 1 just for nothing. NCI on the balance sheet at end of the year. So we're going to take the NCI percentage, of course, times the sub's fair value of net assets at year end. So, the way we're going to calculate it is NCI percentage times the sub's carrying value at the end of year 5 plus the balance in the changes in AD at the end. So, let's put this together. 20% times. So let's pull up our financial statements on page 4. And we're looking for the sub's carrying value at the end of year 5. So we could take all the assets minus all the liabilities. Or what could we take? The common shares and the retained earnings. And just so you know, the common shares will stay the same for the sub for the whole question. Always. So, we've got 10,800 and 10. The common shares for the sub are going to stay the same. They issue any more, or we buy them. That changes our percent ownership, and that's beyond the scope of this course. Okay, so we've got 10,000 plus 10,800, which was the sub's common shares plus their retained earnings, page 4. Now, we need our changes in AD schedule that we did on page 5. So, we go to page 5. Here's our changes in acquisition differential, and our ending balance is 14,450. and that's page 5. So NCI on the balance sheet is 7050. Now, another way to calculate it, so we'll just call this method 2, and it's OR. We're going to take, it's kind of like doing a T account for NCI. We're going to take beginning NCI at acquisition plus NCI on the income statements minus subs dividend to NCI. And you should do beginning NCI at acquisition or previous year, or year in question. Let's do that. In this case, it's acquisition, but if it was year 4, they acquired it in year 2, we'd be doing year 4. End of year 4, beginning of year 5. Okay? So the big thing here is we want the beginning of year 5. Oh, I hope that didn't confuse you. In this year's acquisition. Okay, so on page 3, 6,800 is beginning NCI at acquisition. Then we add the NCI on the income statement that we calculated, which is on page 5, which is 750. Minus subs dividend to NCI. Well, how much dividends did the sub give in total? This is on page 4. Well, they gave 2,500, and how much goes to NCI? 20%. So that is 500. So add, subtract, and you get 7050, and that's NCI on the balance sheet, end of year 5. Now, here's the little issue, is sometimes you don't have this information. On problems. Especially this one, because if you were acquired years ago, you'd have to take that acquisition, and that's the only one you have, plus all the NCI on all the income payments, minus all the dividends for all the years to get the end. But you certainly can do that if you want. Just make sure you go through and double check. So try them in some problems. Try doing both ways. See if you've got the information. And that way you can learn how to do it. Okay. So those are all the calculation pieces you need. So if you look way back at page 1, we've now done the first 2. We skipped those 3 and 4. We've done 5 and 6 and 7. So we've got to complete the consolidation entries and complete the consolidated financial statements. I'm going to do the statements first, and then we'll do the entries, just since everything's fresh in our mind. So we're going to do the consolidated statement, the consolidated retained earnings statement, and the consolidated balance sheet. So that's using the direct method on page 4. So keep all your schedules handy so we can look at them. Okay. So we're doing the direct method, so I'm not going to put the debits and credits. We'll talk about that later. but I am going to put in all the little plus and minus things we have to do. Now, there's going to be 3 sources. We're going to have red, and those are going to be the intercompany transactions, or basic transactions. Then we'll do blue, and we'll do schedule of changes in AD. Whoops. On page 5. And then the green will be taken from our calculations. Page 5 and 6. Okay? So we'll do it in pieces. So let's start with the intercompany transactions. We kind of skip this because there aren't a lot to think of here, but it's going to be the dividends, and it's going to be, this is number 4, the note receivable and the note payable. So let's deal with those. So dividends, what do we have to do with these dividends? It's all from the sub. Can we have it there? No. So we're going to have to put minus 2,000. Okay? Now, that takes care of the parents. We're getting rid of the parents. So over here, it's going to be 0. And usually it's 0, unless they had 2 investments. Happen a lot. Okay, but we also have to get rid of the subs dividends. So we're just going to scratch it up for now. Okay? We're not going to include their dividends. Now, the note payable and the note receivable. Parent has a note receivable, the sub has a note payable. So here's the parent's note receivable. Oh, it must be in miscellaneous assets. So I have to take off 1,000. The sub has a note payable. Well, that must be in liabilities, and I have to take off 1,000. Now, in case you're wondering what happened to that 500, because this isn't balancing like these are, remember we put 2,000, we're taking it off from the parents, and the 500 went into the NCI. So that's how that's taken care of. Okay, that's the intercompany transactions done. Now let's look at the schedule of changes in AD. So I just have to find. So we have to do all these changes on the income statement and make sure the balances are right by adjusting these on the balance sheet. Okay? So remember, these things like the goodwill weren't on anyone's statements to start with, so we're kind of just adding them on. Okay? So keep that handy. And let's just start with the inventory. So inventory, we need to increase cost of goods sold. Inventory has to be 0, what's left. Okay? So cost of goods sold, let's find cost of goods sold. They call it cost of sales, same thing. We need to increase cost of goods sold, and that will make net income go down. Just to get you thinking that way. So increase the expense for the inventory. And then over here, the inventory is gone, so we don't need to adjust it. No adjustment to inventory. It's gone. Sold. It's sold. Okay, so that's the inventory. Now let's look at the next one down, the patent. Well, we need to record patent amortization of $1,500 and then record a patent balance of $10,500. So now there's expenses miscellaneous, so we could put the patent amortization in there. Just because this is our first try at this, I'm going to list it separately. So I'm going to put amortization, and it is $1,500. And now I have to put the patent. Now you notice there's always extra blanks here. That's where you fill the stuff in. So here we need a patent. So we need to put the balance, which is $10,500. We're going to add that on because that's the balance. And notice this will just carry right over there. Okay, that's the patent. We've done two things with the patent. Now we need goodwill. We need an impairment expense of $50, and we need the goodwill balance of $39.50. So again, impairment expense could go into miscellaneous expenses, but you don't have to. I'm going to put a separate line called goodwill impairment, and it's going to be $50. And then down here I have to put goodwill, and it has to be $39.50. And again, it's the balance. Okay, so that's the three things for the schedule of AD. And notice income statement stuff, balances are on the balance sheet. Income statement changes are on the income statement. Okay, income statement, balance sheet, and we know net income's going down. Okay, now we need to put our stuff from all our calculations that we did. So, looking at page 1, we've got consolidated net income, we've got beginning retained earnings, and ending balance sheet NCI. So those are the things we have to put in. So let's do the net income. So looking at our net income calculation, we know our net income should equal 22,050. Okay? Now that's going to break into two pieces. There's going to be the parents portion, which we said was 21,300, and the NCI on the income statement was 750. Okay, so we have to separate that off because it's only the parents that's going to go here into net income.